So here we go. This is our NetSolutions company. This is what they call, what I taught you as a trial balance before. We're going to change its name now and call it an unadjusted trial balance. Because what we do is we get to the end of the month, we tally up all of our ledgers, and we get a trial balance. And then we make our adjustments. And then we're going to create what's called an adjusted trial balance after the adjustments. So let me walk you through some examples of adjustments and see if it's helpful. So here's their first one. Assume that NetSolutions signed an agreement with Danker. Oh, Dankner. Danker would be better, actually. Like that meme was dank, but that one was Danker. I'm pretty sure that's a word, but Dankner works for me. Anyway, they signed an agreement with Dankner Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, NetSolutions had provided 25 hours of services. Okay, again, really normal. They're just doing business. They're providing services to these people. They get to the end of the month, they're going to tally up how much they're owed. Okay, so their adjusting entry for that accrued revenue is going to be to debit accounts receivable, right? That's money owed to them, and to credit their revenue account. In this case, it's fees earned. So $20 times 25 hours is $500. So the adjusting entry is debit accounts receivable 500, credit fees earned $500. And that little part down below where it says accrued fees, that's just a note for them, okay, why or how they're doing it. So there's our first adjusting entry. And again, as part of like a cycle of accounting, we actually do this, okay? We start at the beginning of the month, we record all of our transactions. We get to the last day of the month, we do an unadjusted trial balance. We enter all of our adjusting entries. Then we create from that an adjusted trial balance. And then from that, we create our statements, our income statement, our balance sheet, etc. Okay, that's the process that used to be used when it was done by hand. Now it's still used, but it's done by computer. All right. NetSolutions pays its employees bi-weekly. During December, NetSolutions paid wages of $950 on December 13th. So that's their first payday in December. Looks like they pay every other Friday. And $1,200 on December 27th. As of December 31st, so the money people earned on those 3 days, right, haven't been paid for. So as of December 31st, they owe $250 of wages to employees. So they're going to have to enter an accrued expense where they'll debit the expense account for the wages that were incurred between the 27th and the 31st of the month. So they'll debit the expense and credit the accounts payable. In this case, they're going to call it wages payable, a special type of payable account. Okay, so there's our adjusting entry: debit wages expense, credit wages payable. Let's see. And then this is just showing us in the future on January 10th, when they actually pay the wages, what it would look like. So in the future on January 10th, their next payday, they're going to debit wage expense. That would be for any wages that were incurred from January 1st to January 10th. Plus they're going to debit wages payable. That was for the wage expense that was incurred those last 4 days in December. And then they're going to credit cash because that's all the cash going out. Okay. So with these accruals, what's happening is in essence, we're doing the adjusting entry, and then in the future, we're doing the entry to bring the cash up to it. With the deferrals, we got the cash in advance, and then at the end of the month, we're doing the adjusting entry to show that we've either earned it or incurred it. Okay, that's, again, the more you do it, the more comfortable you get with it. All right, so that's just showing us, okay. So here's our unearned revenue. So December 31st, the unadjusted trial balance of NetSolutions indicates a balance in the unearned rent account of $360. This balance represents the receipt of 3 months rent on December 1st for December, January, and February. At the end of December, 1 month's rent has been earned. So apparently they're renting space to somebody. Somebody paid them for 3 months worth on December 1st. So at the end of December, they're going to recognize 1 month's worth. So if we have 360 in the account and that represents 3 months worth, then the amount of the expense is going to be 1/3 of that, which is $120. So as you can probably guess now, as I walk through a few examples, The hardest part of these is not so much like the math on it, it's the figuring out which accounts are in play and then figuring out how much of it is happening. You have to read that carefully and say, okay, the balance is 360, that represents 3 months. Here, we're only talking about adjusting for 1 month, so I'm gonna have to divide that by 3. That's like the most challenging part of this because it's super easy to get that mixed up as you're working on it. So their adjusting entry, it would be to debit the unearned rent account and then credit the rent earned account. So they debit the unearned revenue. So if I took any notes at all, it would be this that I've just given you, these 4 examples, because the adjusting entries always follow these. It's also in your book, by the way, but I'm just letting you know, like, this is what's going to help as you get stuck on some of these. All right, prepaid expense number 1, December 31st, adjusted trial balance indicates they have a supplies account with a balance of $2,000. Some of these supplies were used during December and some are still on hand, meaning they're not used yet. Assuming that on December 31st, the amount of supplies on hand is $760, then we have to figure out how much we've used, right? So we take the $2,000 that was the balance of the supplies account, we subtract the $760 that are still on hand at the end of December, which means we used $1,240 worth. We've done this entry already in previous chapters. And so we're gonna then debit the supplies expense account and credit the asset account. In this case, it's supplies, okay? Because think about what's happening. The asset's going down, we're recognizing that, and we're claiming it as an expense, right? That's what happens as we use up expenses or assets, as we claim them as an expense. Here's one with prepaid insurance. Debit balance of $2,400 in NetSolutions prepaid insurance account represents a December 1st prepayment for 12 months. So if it's $2,400 and that's 12 months worth, then how much is it monthly? 200, good. So you just took 2,400 divided by 12, that gave you 200 per month. At the end of December, the insurance expense account is increased. The prepaid insurance account is decreased by 200. So we're gonna debit insurance expense to show that we've incurred the cost of insurance for a month, and credit the prepaid insurance account to show that that asset is now $200 less because we've used it up, okay? Okay, so we have a special kind of deferred expense to consider, and it's called depreciation expense. Has anybody ever heard of the term depreciation? Okay, so this book gives what I consider to be a not very good explanation of it, just for my opinion. So depreciation is an accounting term when we're in accounting class. It has nothing to do with an asset losing value, because sometimes an asset could be worth more, like a house. It could go up in value, okay? But it has everything to do with us allocating the cost of the asset over its useful life. So in other words, if I buy a computer and I think it can last 4 years before I have to replace it, and I pay $1,000 for it, again, do I want to just take a $1,000 expense this year? Or is it better to take a $250 expense for the next 4 years and recognize that that cost of that computer is spread out over its life? And the answer is, it's better to spread it out, because we're probably earning revenue from the use of that computer somehow over the next 4 years. So we have to, the matching principle tells us spread that out. So depreciation is the process by which we recognize the cost of an asset as an expense spread out over that asset's useful life, okay? So we depreciate what are called fixed assets or plant assets. Usually that means each company has a slightly different, they'll kind of set the parameters, but like here at EAC, if an asset costs more than $1,000 and is expected to last more than a year, then we call that a fixed asset, as opposed to a supply, which is something that is expected to just be used up, okay? So the most common fixed assets that you deal with will be land, building, equipment, that sort of stuff. Those are the fixed or long-term, you'll sometimes see them called long-term assets. For whatever reason, the IRS does not recognize, and therefore we do not depreciate land, but we depreciate all other fixed assets, yes. So depreciation means I'm trying to not use giant accounting terms, the allocation of the cost of an asset over its useful life, or the taking as an expense the cost of an asset over its useful life. I would actually say you're expensing the asset. Okay, you're actually taking, so I'll give you an example here in a minute. But again, if I buy this computer and it lasts for 4 years, instead of charging myself $1,000 expense today, I'm going to spread that out over the next 4 years and do $250 a year. That's what depreciation means. Okay. To do this, we create a special account called accumulated depreciation. And that is how we track, because what we're going to do is we're going to leave our asset account always at the cost, and then we're going to attach this second account to it to track the depreciation, called an accumulated depreciation account. And they're giving you a new term here. An accumulated depreciation account is a contra account, in this case a contra asset. Okay, and all contra means is it's an asset account, but that has a normal balance on the credit side, on the opposite side of the regular normal balance of that account. Again, when I give you an example of how it's used, that will help. All right. Let's see, that doesn't give us a great example. So, yeah, that's not great. It just says NetSolutions office equipment depreciates $50 during December. So our entry to recognize that depreciation is going to be that we'll debit depreciation expense $50, and we'll credit the accumulated depreciation account $50. I don't think that's really helpful. So let me give you this example with the computer. So when I purchased the computer, I'm going to call it computer equipment. When I purchase it, the asset computer equipment goes up by $1,000, and my cash, right, would go down by $1,000. So that'd be my initial entry when I purchase something like a computer, is I would debit the asset computer equipment, credit the asset cash. That'd be the first entry. Then what I have to do to figure out depreciation is I have to make some estimate as to the useful life of it. So in real life, accountants do that. They just have to make some estimate. So we made an estimate of 4 years. So we're going to say, if it costs $1,000, we're going to divide that by its useful life. That's going to tell me how much depreciation I will do per year. Okay. If I was doing monthly books, then I would have to divide that by the number of months in 4 years, right, to figure out how much monthly depreciation I would do. Okay. So we're going to do an annual book. So we're going to do $250 per year. So at the end of the first year, what I'm going to do is I'm going to debit what's called depreciation expense, $250, and I'm going to credit accumulated depreciation account, $250. And so there's a separate accumulated depreciation account for every asset I have. So this one's called accumulated depreciation, computer equipment. Okay. I'd also have one for building or for trucks or whatever I was depreciating. So after I do that, you can see I didn't change my computer equipment account. Its balance stays the same as my cost, but I'm going to have another account called accumulated depreciation. I'm just going to call that AD computer equipment. And now that's going to have a credit balance of $250. Accumulated depreciation accounts are always linked to their specific asset. Okay, so the accumulated depreciation computer equipment account is linked to the computer equipment account. And so the term that you'll see come up is book value. If someone says, what's the book value of an asset? It's the cost of the asset minus its accumulated depreciation. So after 1 year, our computer equipment book value is going to be $750. And it'll actually show on the balance sheet. It'll say, in the asset section, it'll say computer equipment, And then there'll be a second line that will say less accumulated depreciation. And then it will give you a total of 750. Okay, 1,000 minus 250. At the end of the second year, we're going to do this exact same adjusting entry. So now this will have a balance of 500. And at the end of the third year, we'll do it again. And at the end of the fourth year, and now we'll say that asset, computer equipment, is fully depreciated. It doesn't mean it's worthless. Maybe the computer's still working. Maybe we're still using it. What it means is we have fully claimed as an expense the cost of that computer. Again, don't get into your head that we're talking about the value of it or the usefulness of the item. That's just an estimate. Some computers might last 10 years, right? I don't know. But based on past experience, we had to make an estimate of 4 years. And so that's how we claim the expense of it. So all we're doing with depreciation is we're claiming the expense of the cost of the asset spread out over time. That's all. As you do more, again, I see some of you look worried. Don't worry, you can do this. All right. So here's a summary of the adjusting process. I'll just let you look at that for a second and not talk to you. That's what we just went through. The other good news is we will do a guided assignment on this tomorrow, right? So we'll go through it. There's a summary of the adjusting entries. Again, those are just the ones I just went through. You'll see they all have the date of the last day of the month, because adjusting entries are always made on the last day of the month. Here's the ledger, so you'll see the new balances of each of those accounts. You'll see cash didn't change because there's never cash in adjusting entries. But accounts receivable changed. And you'll actually see like they'll be labeled as adjusting entries when you see in people's books. There's the other accounts that were changed. And then at the end, since we made changes to accounts, we're going to have to adjust our trial balance. And that's going to be called our adjusted trial balance. Once you have your adjusted trial balance, which means all your revenues are right and your expenses are right, and any of those assets that were impacted by those changes and liability accounts, now we can use that. We have all the info we need, right? These top ones, assets, liabilities, stockholders' equity, we can make a balance sheet. Dividends, so now we can use that to make statement of retained earnings. And then revenues and expenses, we can make our income statement. So that's why the trial balance, right? It has all the info you need to prepare those statements.